Hello and welcome to Your Property Empire. I'm Chris Gray. On tonight's show, with New Zealand property buyers needing to put down 40% deposit in order to finance an investment property, what are the chances that Australia might follow suit? What are the benefits of investing in commercial property? And how does depreciation change when it comes to commercial versus residential property? But first up, recent data shows that rental rates are falling around Australia. So what does this say about the current market conditions? Well, joining me tonight to give their opinions is Charles Tarbey, Chairman and owner of Century 21 Australasia, and Brad Beer from BMT Tax Depreciation. Charles, tell us about the rents and what it means.
Oh, I didn't realise I was on first tonight.
Right, okay. So rental rates are falling.
I've got a surprise mystery guest here. I didn't even
know. We're going to be hearing about Brad's Christmas coming. He loves the 1st of July.
We have very similar PR consultants, and that's probably how he's ended up here. I have to check a little later on. The rents around the country, I guess I expected them to stabilise, and we've been watching them stabilise for some time. In fact, if you look at the start of the year, and I'll touch on the figures later on, it's almost line ball since the start of the year. I think also because of the fact that more investors have gotten into the marketplace, vacancy rates have increased in some parts of the country. The landlords have to be very careful because I think rents could come down in certain areas, not go up, and that's an area for discussion.
And so if the rental rates are already coming down, there's been so much talk recently about all of these new apartments, especially in Melbourne and Brisbane, and then there's talk of the foreigners not being able to finance these. Is this going to compound it more and more?
I think it definitely will, because not only is that an issue, but there's an issue we've talked about also of valuations before settlement that banks might be calling up on. And if you look at what you spoke about in the introduction with New Zealand, I mean, APRA did everything they could to slow down the investors before on a couple of occasions. Now with New Zealand introducing a 40% deposit, 60% LVR, it could mean that the investors might not go into the market in New Zealand, and therefore there could be a shortage of property. But that's not the issue we have here right now.
And I guess what's your advice for landlords that have got a good tenant now? Do they want to kind of send them Christmas presents and make sure they stay? And what about the new landlords that are coming up saying, what do you do to get a tenant in?
And I watched it over the years, and still in my property management business, so of the landlords who are pushing too much for the yield, the ones who looked at what their repayments are going to be, and they measured the rental return needed based on what they borrowed, they're the ones that could get into trouble. It's always been my view that if you offer a property for lower than what the current marketplace is, the tenant will look after it. They never want to leave it. When you go to inspect it, it's always immaculate. You've got to take a hit if you really want to keep a good tenant. I mentioned this before. You should, in some cases, mow their lawns for them. Have somebody come around and mow lawns once a fortnight. I think it's a great service, and it also keeps your property immaculate. And if your lawn mowing guy's a mate of yours, he can tell you what's going around the house too.
And again, $5 or $10 or even $10 or $20 to get these things going in.
You're going to hire a lawnmower guy for all his investments now, so he can find out what's really going on.
Well, exactly, and he can probably get some depreciation on it as well. But before we jump into the depreciation thing, we'll jump to Tom Panos in the Sydney CBD studio. We'll catch him early and see what properties are on the market. Welcome, Tom.
Hi, Chris. How you going?
Good to see you. So let's jump in. Number one.
Okay, number one coming from WA, Stirling is the suburb. Spoke to Julie Padula. This property, I'll give you the price guide first. 1.749 million to 1.849 million. Glamour, the epitome of glamour and elegance is home. Cutting edge design, premium luxury right throughout, well appointed. It is a spectacular property. 18 Salerno Avenue, Stirling, and it's available by private sale.
Wonderful, and certainly a few of the photos coming up just on our screens there. So, an immaculate property. Is this something brand new, Tom, or just recently renovated?
Look, I can't tell you exactly. It's one of the two. I'm sounding like a politician there.
Tom, you're the best politician I know.
Yeah, but let me just now sound like a salesperson and tell you that go on, have a look at it. It's on realestate.com, 18 Salerno. Google it. It was in the Sunday Times as well. But it's a beautiful home. And look at the outdoor area and the swimming pool, which I think maybe those photos have come up there.
Yep, looks absolutely fantastic. Okay, let's jump into number 2, thanks.
Yeah, number 2, Julia Coe from Ray White in Queensland there. I didn't realise, Sam and Julia, the team there, the number 1 operators for the Ray White Group in Queensland, 33 Vespa Crescent Surface Paradise. It's designed by residential designer Jared Poole, elegant interiors. What I liked about this one was the size of the block, 2,017 square metres, and it also shares a 1-acre communal park, 5 spacious bedrooms. Gold Coast is showing positive signs. You know, first time in a long time Gold Coast has had its challenges, and this price of $4 million plus, it's a forthcoming auction. I'd suggest that you get your viewers to look more into that one as well.
4 cars and a massive pool, Tom. That's right up my street.
Yeah.
Just got to move it to Sydney if I can, but never mind. Now, just on some other news, I mean, obviously you're an auctioneer, so you see a lot of real estate agents in action, and also you see the vendors dealing with the agents, and also you've got a real estate coaching business as well.
Yeah.
What would you say are the biggest mistakes when people are picking their agent? Like we were talking with Charles before about even just the rents, you've got to pick the right property manager, but what about the sales agent?
Yeah, I'm really strong on this point, and there are 3 things that I see vendors do wrong when they're selecting an agent. The first thing that they do is they select an agent when selling based on the price that the agent gives them on what the agent thinks will achieve for the value of that home. Now, let's be very clear. There's this thing that sometimes happens where agents go in and they overprice to get the listing. There used to be a saying that the biggest liar gets the job. I suggest that
Tom, I'm going to dispute that. Oh my God, this is terrible. This is terrible. This is terrible news to me. That
Tom is telling the truth in real estate.
Yes, Charles Tarbey wrote the book. So the bottom line is, do not list with an agent that comes in and tells you telephone numbers when the reality is the market's going to determine what the property's going to sell for. The second biggest mistake I see with vendors is that they decide that they don't want to market it. And I see a lot of people spend more money insuring their own car than insuring to make sure that they don't undersell the biggest asset you own.
Now, sorry, Tom, but this is coming from an advertising guy now, that they should spend more money on advertising. See? I'm going to have a chat to you later on, Tom.
Well, he is right, because the reality is I'm employed by News Corp, and I'm not saying that you should spend the money with News Corp. What I'm saying is you can't sell a secret, and I think Charles Tarbey will be the first one to tell you that, generally speaking, the best properties that get best prices are the ones that are the best marketed properties.
It's price or marketing, Tom. We always say that. 2 reasons, price or marketing. And I know what the third one is you're going to say, so let's hear about it.
Okay, so the third one is, don't go with the person that gives you the lowest fee.
Cheap commission, yeah.
Exactly.
Because the reality is if a real estate agent is purely going to get their business because they're going to win it, because they've got nothing else to offer but a low fee, that should raise alarm bells for a vendor. And what you really want is not an agent with the lowest fee. You want an agent that's got the best negotiation ability, the track record, the ability to get people to fight over a property, because we know that competition wins the Olympic Games gold medal, and competition gets top dollar in real estate. So in summary, pick an agent that is a good negotiator, that can market it to the wider audience, that has got the ability to create competition, has a good database of people that they've dealt with, knows how to market property well, and whether you're paying a doctor or a lawyer, generally speaking, the cheapest agent and the best agent are generally not the same person.
100%, Tom. I agree with you exactly. I had the same conversation with the client today. All right, we've got to run, but we'll catch you again next week. Thanks for the input.
So much.
I'll speak to you later, Tom.
And Charles and Tom will have a chat later. Brad, we're going to jump to you to get in before the break. This has got to be the best time of the year for you guys. For someone that doesn't know about depreciation, I'm assuming all the viewers know, but let's just tell them exactly what it's all about.
Look, depreciation is simple. Wear and tear on your investment property, and it becomes a tax deduction. Things are wearing out. Tax office says, based on the items in that property wearing out, we make deductions for that wear and tear. We get some more cash back out of our tax returns. And being July or mid-July, people are getting their group certificates from their employer at the moment, and it's the time where pretty soon you'll visit your accountant. If you've got an investment property, look, we've done some research. 70 or 80% of people don't maximise the deduction properly, just leaving some money on the table for the tax office to play with, which investors are trying to make money out of property, not leave it with the tax office where possible.
And so, especially leading on from Charles's conversation before, is if a lot of the rents are down and people are, say, struggling with cash flow, rather than whinge and try and get that extra $5 or $10 and risk losing your tenant, things like depreciation doesn't really cost them anything and can give them that cash back.
Look, the cost is minimal in relation to the value, I guess. And when the property markets are slow or the rents are down, we actually still do good numbers in those areas because people are starting to look for the other deductions that they, when it was flying along and doing a little bit better, maybe weren't so concerned about. So they're often a bit more likely to contact because they're like, well, the accountant then actually gets a bit more active and says, well, we better look for some money somewhere else. And the things that they should have probably done properly in the first place often get concentrated on a little bit better at that time.
Yep. Well, we'll delve into a bit more detail after the break and talk about the residential and commercial. But we're going to take a quick break. We'll be back literally in a couple of seconds, so join us soon. Welcome back to Your Property Empire. Well, before the break, we're talking about tax depreciation, how to boost your cash flow, and we'll talk a bit more about that. So I guess the classic thing then is, what's the difference between old and new properties? Is it a simple thing that new properties you get tax depreciation, old you get a bit less?
Well, there's one time, and it's 1987, that makes a fair difference. Like if it's built before then, it's a bit of a difference. After then, a bit of a difference. Simple is yes, new gets the most, but near new is not much different. So the things aren't quite as new. It comes down to sort of a construction cost and a value on a bunch of things in the property. So if it's 2 years old, most things are pretty much new, so they're worth a little bit less. 10 years old, worth a little bit less again. That 1987 date sort of relates to a piece of legislation that makes a bit more of a change than just new versus old. But the simple fact is we say, look, don't worry about the age. Old stuff still gets something. Yeah.
And
we'll help with that.
I guess just like asking an accountant, should you ever do something purely for tax? And the answer is generally no. Being a depreciation expert, would you, and you're an investor as well, would you buy properties just because you get an extra 5 or 10 grand of depreciation, or are you concentrating on the asset that you're buying?
I'm the depreciation guy, and I would concentrate first on the asset I'm buying. Now, if I'm lining up two properties next to each other and there's nothing different but depreciation, well, it's a cash flow issue on the way through that you should choose. But the asset you're buying, the growth of that, we don't make money out of depreciation. We're making a deduction for a loss. So the fundamentals of the growth of that asset and the growth of that property and the rest of the things that matter probably come before depreciation. Once you've got it, depreciation helps your cash flow, so you should do it properly when it gets to that stage, absolutely.
Yeah. So you really want that $1 million doubling to $2 million as soon as you can, and if you can get some extra depreciation, it's worth it.
Look, what I've got to be able to do is fund the property on the way through.
Yeah. And
so I crunch the numbers first, including depreciation, so that you know you can afford it, so you can hold on to it while it turns from $1 million to $2 million.
Sounds like a very good answer.
He's the guy, he knows it.
Exactly.
He invented it.
See,
I think you invented it.
See, he's not quite an accountant, he's a depreciation man, so is that kind of, that's 50% good or bad, rather?
I'm a quantity surveyor.
Yeah.
I've known Brad for so many years now, and I've watched your business grow and the way you've done things. So these guys,
someone to look up to.
For me, even when he's sitting down.
Now let's talk about the Kiwis.
Oh yes.
So I got a link during the week. 40% that these investors, to me that's a scary move.
Yeah.
And it hits the first home buyers, and we don't want that in Australia, do we?
I was there when that was announced last week. And the thing is, it's against investors, but if you remember going back with APRA and so on, with the investors here in Australia, I don't think it worked. I don't think it worked at all, because the investors are still out there, the interest rates are dropping, there's still not enough stock in certain areas, in quality areas, where the investors wanted to buy. I'm not sure if what APRA did had any real impact on slowing the market down, because that was what it was all about. Have you seen anything slowing down in certain areas of Australia? No. Yeah. I mean, there are other areas that are struggling and suffering, but in those key capital cities and in key suburbs, it has not slowed down at all. It's still growing.
And I think it's screwing the wrong people. It's screwing the first home buyers, and the locals that want to buy their first investment,
Correct.
it's not touching the foreigners because they're the ones with the cash.
Well, you know how we always talk about the fact that people who buy their first home necessarily should not necessarily try and buy it where they want to live. So they might rent in the city and they want to go out and buy an investment property where they can afford it. Well, that's going to really destroy their chances, as you're saying. So I don't think they've thought it through. I don't think it's impacting on investors at all. I think it's impacting very heavily on first-home buyers. And most investors, if they've done the right things over the last couple of years, have got enough equity to let the 60% work.
Yeah, so I think it's getting the wrong people all the way.
I do. And look, they did this in Auckland last year. First-home buyers, they made first-home buyers LVR higher, and that really caused some damage.
What they're looking to do in New Zealand is also, not as badly, but limit owner-occupiers to LVR a certain percentage as well. I think it's 10% of the owner-occupiers are only allowed to have an 80% LVR. So you're kind of restricting everybody, which...
But the wrong people, I think.
Yeah. Well, Brad, the market's great. It's been pretty good in New Zealand overall, and I think it's a knee-jerk reaction, and most of these things always come in towards the end when they really should have been a long time ago, thought about a long time ago.
Let's jump into something else. Commercial. I gather you're doing commercial now.
Well, we are. We have been for a long time. We launched a larger division in Sydney just a month ago, James Barlow and his team. And these guys are working in a different tier, and it's really quite interesting to watch, because if you look at the larger commercial agents across the planet, they've started merging themselves very heavily into residential and residential projects, and so it's only fitting that we go out and challenge them on the other side. And there's a significant number of offices within C21 that, if given the right guidance, can consolidate certain developments, and they might not have had that expertise before. With the team coming in now, we've already collectively put together a site. One of their first transactions they did was a $30 million consolidation of residential and commercial development in the northwest sector of Sydney. And I think a lot of the larger organisations in commercial sometimes think, we're too busy for those sorts of transactions. So we're noticing a very large interest in areas like that. So.
Might be getting into depreciation soon.
We use Brad. All of our family uses Brad.
Commercial versus residential, what difference does it make when coming to depreciation?
Look, I think one difference would be the fact that on your house you can't claim depreciation because you live in it. If you run a business from your commercial property, it actually becomes an investment property for the purpose of depreciation. A lot of people seem to even talk investment versus owner-occupier in commercial. Commercial still has the same rules for depreciation that an investor does in that. The date that matters for the purpose of some building allowance is actually a bit longer, so it's 1982, not 1987. So slightly older buildings still have that decent depreciation there. Once again, though, age doesn't matter. Still some deductions available, just more when it's a bit newer and more when it's in that 82 to 87 construction time bracket. They change a few little things in relation to certain items. Now, depreciation is about the wear and tear of something and how long it should last. So if you think about it, carpet in a commercial property, in an office, probably doesn't last as long as your house. So the tax office lets us claim it a little bit quicker. And there's a few little items like that actually change in that situation.
Okay, interesting stuff. Clearance rates. Let's jump into your charts.
Okay, yeah, still reasonably steady across the country. 70.7% from a national perspective. This time last year was 77.7%. So it's still down. And again, I think if you take out certain locations and suburbs, the clearance rates would be higher than the national average, significantly higher in certain areas. Sydney was the best performing capital city, and it came in at 75.3%. That was followed by Melbourne at 72.4%, but the big winner this week, coming in third, is Adelaide at 71.8% clearance rate. So Canberra also jumped up to 68% from the pretty dismal performance just after the election. So there you go. Maybe there's a rebound there as well.
Wonderful.
Pretty good movement. I think the rates are exceptional for this time of year.
Yeah, that's good. Homes advertised for sale.
Down again, and I got a call from my good mate Graham Mirabito at RP Data, and we were chatting very heavily about this, because normally you start to see them coming on now ready for spring, but they were down 1.45% this week, the week before, and in the New Zealand market they rebounded heavily a week ago, up plus 8%, this week down 7%. So I'm not really sure what's going on yet, hard to predict.
Okay, and we talked about rent price at the start of the show, but let's look at the graph.
Again, very steady, Chris, right across the country. The two worst performers, if you like, were Sydney at 0.28% over this time last week, and we had a Perth market, which is, as we all know, is having a tough time. That was negative 0.44%. But overall, it was a plus 0.24% across the nation. So, you know, it's still pretty level compared to the start of the year. It's almost as though we've had no movement at all if you look at the line on the chart.
Okay, and finally the vacancy rates.
Now, here's a worrying one. Sydney has been exceptional, as it has been for some time, at 1.7% clearance rate. The Melbourne market is 2.02. That's really good. They were in the 3s and 4s for a while. Perth, 9.13% vacancy rate. It's been going up and up and up and up. I mean, that's 4.28% over those three as an average. But Perth is still a worrying marketplace when it comes to...
And is that the whole of Perth, or is it just certain segments within it?
I think most of that marketplace is going through an adjustment, a probably well-deserved adjustment, because the prices were a bit crazy. Commercial real estate there has also dropped significantly, and they're offering incentives, whereas before they wouldn't even talk to you. So it is very much a changing market there.
Wonderful. Thanks for that. Very quickly, got about 30 seconds left. One of the other great advantages is with depreciation, the other taxes, you can get it back monthly if you speak to your accountant, can't you?
Yes. We do depreciation schedules throughout the year, and a lot of people are actually, rather than waiting for the end of the financial year and getting a big whack of money, as soon as you buy that property or as soon as you're preparing a tax return, the accountant can actually adjust next year's or adjust what your employer is actually taking out of your tax return, so you just get the cash flow on a weekly basis. The depreciation schedule helps that to happen, and the accountant actually just submits to the tax office and stop the employer taking so much tax out of your income all the time.
Exactly. Bit of a tip in case cash is tough. Brad Beer from BMT.
Thank you.
Tarbey from Century Joiner. Thanks for joining us. Thanks for joining us at home as well. We'll be back next week. Until then, I'm Chris Gray. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.